Okay, I guess we'll get started. Thanks. Yeah, my name is John Demeter with John Gortakowski. We've spent a few years now pretty intensely working on improving our business income tax form set. Business income tax in Vermont, not to be confused with corporate income tax. Business income tax is the annual return filed by our pass-through entities. So that's the S corporations, partnerships, and LLCs that file as those two entities. What we intend to do today is to go through in fairly sophisticated detail the key schedules that have been improved and upgraded over the past couple of years. So our main return, the BI 471, hasn't changed a whole lot. Similarly, the BI 472 and 3, which are schedules that get you to either a non-resident estimated payment estimate or an actual composite tax due. Those haven't changed much either, and the changes that have been made have been simplification, so those are not going to be the focus of what we're doing today. The focus will be our schedule BI 477, which was new as of 2 years ago. So this is the third year. We debuted it 2 years ago, had a couple modifications last year, and a couple more modifications this year. Hopefully we've hit a steady state now, identifying most of the challenges that we had with it. The purpose of this schedule is twofold. We'll get into a lot more detail on this, but mainly to start with amounts of federal income and items, make the state adjustments make the state adjustments necessary to get to Vermont taxable amounts, and then also do sourcing, very importantly. What's your taxable Vermont income and what's not? The second schedule we're going to go into deep detail on is the Schedule K1 VT. I'm confident everyone knows what Schedule K and Schedule K1 are at the federal level. And you all know that we've had these for Vermont for many years, going back 20 plus years. The schedule's been a challenge in a lot of ways for years, but this year is our true attempt to level it up and make it a lot more functional at the state reporting level, parallel to what it does at the federal level. And again, we'll talk a little bit more on the detail and context of that history as we get into it. Finally, we're going to go through the BI 476, which is the short form for business income tax. We've had that for a good number of years now, better part of a decade at least. And the idea is for this form could be filed by those pass-through entities that have really simple organizational structures and ownership structures and reporting. The idea was so that they didn't, our small mom and pops, for example, that operate only in Vermont, are owned only by Vermonters, they're going to be paying Vermont personal income tax return. We don't have to worry about chasing the stuff around the country, tracking it through layers. But that's a simple was a one-page schedule. It's another page now that they could form. But the point is we've made some improvements to that form as well, and also opened up the eligibility, so a much greater number of businesses will be eligible to file the simple short form 476. So those are the three forms and schedules that we'll be reviewing in detail. We want to start off with some overview and context before we dive right into the schedules, because the bulk of this presentation between today and Thursday is really us going to be going line by line and section by section through the 477 and the K1 to hopefully provide the hands-on level of information of why the form is set up the way it is, where you report items, when you see something, when you have a tax position that doesn't make sense, where we've made accommodations to put that, because we've put a lot of intent into allowing that kind of flexibility. But before we get right into the line items and the nitty-gritty, we want to just kind of talk about where we've been and how we got to where we are today. John, not on long. Anything to add, or should I keep on rolling?
No, keep going.
Just give me a nudge, and I'll see when my voice gives out also. Okay, so yeah, a couple things. I'm gonna just going back to 1996 or 1997 or so. State of Vermont only had the corporate income tax return. It was back around that time frame that we acknowledged the existence of partnerships and S corps and started the business income tax. And so the business income tax is really just reporting. You pay your $250 entity tax. It's presumed that any Vermont owners to whom that income is passing through are going to make their own quarterly estimated payments in line with our personal income tax laws. But for those entities that have owners who are non-residents of Vermont, we have our statutes 5914 and 5920, which require quarterly payments made by the entities, but on behalf of the non-resident owners. So that was kind of the crux of the early statutes there. Like the biggest administrable thing was requiring these non-resident estimated payments. So these would come in and still do come in quarterly, and we'd have to parse them out. They'd be with the form WH-435, or the payment coupon. And our main purpose was just to get that money to the owners, whether they're individuals or corporations, so that when those entities filed their income tax return come April or October on extension, those estimated payments were sitting there in the right amount. So in the crude technology that we had, very paper-based, mainframe technology system, we took the payments, we kind of parsed them out when they came in, and then the return package of the BI 471 had these K1s, and they were like nominally scheduled K1s. We called them K1s, but they didn't do what federal K1s did, like in terms of reporting all the different types of income and being like functional in terms of assisting the businesses and individuals in preparing their personal income tax return. There were like some crude numbers on there of like income, but it was really all about getting the percentage right. So if the entity sent in $10,000 over the course of the year, we knew how to split that up and get it to the people that were filing. So that was, that's when I started in the department in 2004. That's what we were looking at, and I was just learning about taxes at that time. And then over the intervening decade, we made some attempts to parse out. As the world got more sophisticated, partnerships and LLCs became a lot more prevalent. We wanted to do a little more tracking, and we slowly, we got a couple of guests, come on in. We slowly kind of piecemeal started adding items to the Schedule K1 and the 472 and the 473 to accommodate for when businesses had like legitimate tax circumstances or positions and the non-resident estimated payments were going to be overstated or understated, just not correct. And how do we fix this? How do we adjust for the whole universe of federal partnership taxation on these schedules? So over the years, we did a couple different rounds of adding things like, oh, well, what's a capital gain here? What's non-business income here? We had to adjust for bonus depreciation. But most of those were just us doing our best to kind of address situations one at a time. Where we're at now and the effort that largely John put in, I want to give credit where due, is to have taken a holistic approach. And the impetus for doing that was when the legislature a few years ago made significant changes to the corporate income tax, right? So we had done market-based sourcing from cost of performance a few years ago. So that's for the sales and sourcing of intangibles. But then a year later, we switched our method of unitary tax reporting. Won't get into the detail here. That's next year's symposium, maybe. But significantly for this conversation, we went from our three-factor apportionment methodology of sales and receipts, wages, and payroll, and then property. So we went from that three-factor apportionment down to a single sales factor, which is a direction that a lot of states had already gone in, and our legislature tried to move forward that way. So we were tasked with the project of updating our corporate forms and regulations to correctly administer the new statutes. And that really, as we were looking through the business income tax forms, the single sales, the move to single sales really highlighted some challenges that we had been having. We knew we had, with the business income schedules and the K1. So we were able to kind of leverage that realization, aha moment in the momentum of updating the corporate stuff to do a little bit of intentional mission creep to get to where we are with the business income tax stuff. So let's see, did I miss anything big there? Or am I kind of on point?
You're still on point.
All right, thank you. Not bad, not bad. All right. Anything in the chat yet at all? Yeah, all right. So kind of that leads us to, in administering the state level of pass-through taxes, like the complexities, like what's the problem we're really trying to solve here? And I don't just mean for the state side, the Vermont Department of Taxes side, but what are tax preparers and businesses trying to do for their clients for the correct reporting? And so there's a couple real challenges that we've run into that these Band-Aids over the years we're trying to address. But one that always struck me was that the owners, as we all know, of a pass-through entity they're not all the same. They could be individuals, they could be trusts, they could be a C corporation, they could be another pass-through. Vermont state tax law, these entities fall under different sets of tax provisions. They're kind of largely similar, but there are some key differences in the way you parse out income and that an individual would report and pay tax on a transaction versus a corporation. So that's one of the big things is you could have a transaction or set of transactions that are undertaken by a pass-through business, and if you have the permutation of the ownership type, it would be taxed differently to a corporation than an individual, and it might be taxed or addressed differently to a non-resident individual than a resident individual. And so when we're trying to parse that out to get to either the correct estimated payment amount or the correct composite amount, it's like, how do we account for that? In our corporate income tax team, who some of the teams in the room right now, that's a lot of questions that we've taken over the years as we have preparers and businesses doing their best to get it right, saying, well, we have these transactions, and as I run through the math on this schedule, it just makes absolutely no sense. How can we get to the right amount so we're not, grossly overpaying estimates when we know what the tax liability is going to be on the other end for one reason or another. So that's one of the big things, one of the big challenges we're trying to address, giving businesses the opportunity to get it right, get the right amount without overpaying, of course without underpaying as well. The other big question that of course the federal government doesn't have to worry about is the sourcing of income. So this has gotten trickier and trickier and more sophisticated over the years in terms of moving from strictly a brick and mortar economy to just so much digital stuff going on, so much delivery stuff moving around. But so that's something that we thought really intentionally about as we went through this and really tried to integrate a decade of challenges and questions into getting to where we are with this. So those are two of the really big issues that we are trying to solve. So in order to get that right, we need a set of schedules that can report the sourcing of the income, determine where that's happening, probably pass it, or in some cases pass it through multiple layers. That's a thing that we'll get into as well. But then also provide good information to the shareholders, partners, and members so that they and their preparers can go and fill out their returns accurately. And so that's something that, again, we had tried to do a couple times in a non-holistic fashion, where you'd see some of those lines on the prior K1 say, well, capital gains, what is that? Non-business income, because I even think 15 years ago, we had this simple distinction of what's business income and what's non-business income. That's a portion, that's allocated. The whole world has gotten a lot more sophisticated, right? It's those basic frameworks still kind of make sense, but in terms of when you're doing one specific tax return, you need to have a lot more specifics than that. And so we're trying to understand and accommodate for that. So in order to kind of achieve, address these, again, I like to say the problem we're trying to solve here, the problems we're trying to solve, how can we create a schedule that goes with the business income tax return that's going to do these things? And also, I can't highlight enough and not make it infinitely complicated, right? We are very concerned with and intentional about administrative burden on taxpayers, because anything that's tough for taxpayers to do, it's tough for us to do as well, right? It's a mutual interest in getting to simplicity and clarity. And there's only so much that's possible in this complex world, but I can't overstate how much that's been an intentional driving factor as we put this together. And I know the forms and schedules might start to look a little intimidating, but we're going to try to point out as we go through where the logic of them, and how a lot of entities aren't going to have to worry about a lot of this stuff, but it's again the opportunity to get it right for those. But yeah, so what could we use that we had? And so again, going back and forth between, all right, who is paying tax on this income? The two big buckets are individuals and C corporations, right? There's the trust, there's some URBI and nonprofit and stuff, but it's really C corps and individuals. And so we could have made a set of schedules that takes everything out and breaks it out by entity type, but that's a little ridiculous. It would be a lot to have multiple columns for the income. For a state of our size, and we saw models that are similar to that. We looked at a bunch of other states' form sets and schedules that really go into every layer of detail. For the size of our state and the size of our staff and our resources, we had to find something that would fit. But so we had to make a choice. We had to get to a decision point where we're going to do these calculations. We can't do both personal income tax and corporate income tax at the same time. So we had to pick one or the other, and we went with the non-resident personal income tax. So we'll spend time in a couple minutes going through Vermont statute 32 VSA 5823B, which is lays out the points of what's taxable income to non-residents and part-year residents, because that's a guiding foundational principle here. That's how we're getting from A to B, where B is how much tax is Jane Smith actually paying, right? But we realize that that's not always going to be correct, because there are corporations that are owners of these things. So what we've done is we actually have provided areas to reclassify items of income, where if our default mode on the schedule is not going to work out because of either the nature of the business, the nature of the transaction, or the ownership type, we have provided opportunities to make statements and make adjustments right on the schedule, so it doesn't have to be a mystery, or what John sometimes refers to as the secret menu of tax preparation, like putting stuff in the back. Nobody wants that. But so that's one foundational thing about the structure of this BI 477. We are looking at 5823B. That's a guiding principle. The other is, let's just use the information that everybody's already doing, and that's the Schedule K and the K1. So when we created the 477, as we were brainstorming through, we kind of went through many of the categories of income that are laid out on Schedule K. And then as we updated the K1 this year, and we'll get into detail on that, it's almost identical to Federal Schedule K. So that our kind of main reasoning behind that, when it, again, it's like an aha thing. It was very obvious in retrospect, but to get from A to B is everyone's already prepared this. Individuals, businesses, accountants know what the Schedule K is. It's going to inform your federal tax reporting. It's already done. And we really hope that the software companies are going to kind of glom onto this and adopt it as well, so that when you see your Vermont K1, it's going to have two columns on it, the everywhere and the Vermont, and the everywhere should pretty much just be populated. And the Vermont tax preparer is just going to have to primarily say, okay, was this a Vermont item or an everywhere else item? Not there. But so that's the goal in terms of prepared and everyone's familiar with. So it's more thorough, it allows for more accurate reporting, and hopefully it's simpler, even though it's more lines, just because it's based on existing information. So yeah, that's kind of most of the background I think I wanted to hit, and I'll just repeat those last 2 points again as we go through the schedules. So they're like a guidepost if you get a little confusing. It's 1, 5823B, what's taxable ultimately to the individual, and then the adjustments that we could make for corporations or other entity types, and we'll go through those in detail where they are on the 477, and then kind of meshing that 5823B with the Schedule K1 so that we can actually report useful financial and other information through to the shareholders so that they could prepare their returns accurately. I'm going to take a breath right there and reset because that's a lot of density of information, and I've said it a lot lately. Are there any questions or comments, Maud? Yeah.
Anybody in the room?
Yeah.
Any?
Yeah, John, do you have anything?
I think I'll save my thoughts for when we actually have the forms up.
Okay, yeah, when we get into the more details.
Yeah, you know, I guess maybe one thing I wanted to just emphasize, because we've been getting this question a lot, is Vermont still doesn't have a pass-through entity tax. Even though what we're going to be talking about today and on Thursday is, you know, basically calculating these estimated taxes on the entity level, it's still not a PT tax. You know, it's a composite tax and it's a non-resident withholding calculation. So, you know, having a PT tax was something the legislature considered a handful of years ago when a lot of states were adopting PT taxes. They ultimately decided not to do it. Then I can't imagine with the SALT cap being increased for at least a few years that there's going to be much desire to reconsider that decision. Maybe in the future, if and when the SALT cap does go back down, maybe that's something they might. Yeah, I figured that would be the question we get. That's something that you know, the legislature might consider again. Okay, we can look at the questions.
Yeah, Maud, do you?
So, just the statute that you referenced, can you repeat what that was?
Okay. Yeah, do you think, is the mic picking you up? Do I need to repeat the question, or?
I think the mic is picking me up.
Okay. Yeah, there are a couple statutes, and you know, I'll try not to spew too many 4-digit numbers as we go through, but we're largely within Chapter 151 of Title 132, and Chapter 151 is all about income taxes, both personal, estate, trust, and corporate all lives in there.
Wait, slow down.
Sorry.
151 of Title what?
Title 32,
Thank you.
Chapter 151.
Okay.
But there's a couple specific ones I mentioned so far, and one is 5823, parentheses B, 23, and parentheses small b.
Okay.
And that lays out in a few subsections the definitions of what's taxable to non-resident Vermonters. So people that live outside of state but have income in state. And actually, I'm going to say the other statutes I mentioned real quick, but now's a good time because I have that up on my screen, and I think now's as good a time as any just to walk through that quickly.
Okay.
Just to confirm,
Yeah.
Title 32, Chapter 151.
Yeah, that's section, like you could write SEC in there.
Where here?
I used to know how to do the section symbol on my keyboard, but Microsoft changed that years
That
ago.
lays out definitions of what's taxable to non-Vermont residents.
Yeah, taxable income, basically. Or, I mean, if my attorney wants to be like more specific with the
I
definition.
believe it's called Vermont income.
Yeah.
But,
Here, let me go ahead and share that. But I'll just say there were two other statutes that I mentioned.
Okay.
58
actually,
or 5914 and 5920.
59, 20.
And those address the taxation of S corporations and partnerships.
Okay.
What's the other one,
5923B. Yeah, and did you want to tax them?
I'm gonna wordsmith Maud's response.
Okay.
I'll do that right now.
Okay.
Yeah, I didn't have anything more about PT tax.
Okay.
Other than, I guess my final thought about the PT tax is that, you know, PT tax is obviously calculated on entity level. We're doing the same thing for composite and NRW. We're calculating a federal and a Vermont tax base for a pass-through entity on the entity level. And that's what the 477 is doing. And then we're going to distribute those income items to the owners. Just, you know, some big picture.
Yeah. Yeah, again, we're doing like kind of this broad big picture stuff first before we dial into the details. But so, yeah, going down here, I'm going to share on my screen. Let's see if I can successfully do this. get the right window. Okay, so on our legislative page, okay, the whole thing's coming up, looks good. The 5823B, we're in A right here, the Vermont resident of a or the Vermont income of a resident individual. But we're going to slide down because again, our resident individuals are just paying their own quarterlies into state. That's how our statutes are set up. So over here, B, the income of a non-resident individual, estate, or trust. Some of the following items of income that are required. So we have rents, royalties derived from ownership of property within the state. And so I guess right as I say that, I want to get in again into this distinction of how items of income are going to be sourced, and are they going to be allocated or directly sourced to the place where they happen, or are they going to fall into an apportionable bucket of income? And so again, when I go back to the problems we're trying to solve, is that things that in this piece of statute are cited to be directly allocated. It's like saying rents are going, if the rent is in Vermont, it's going to be taxable in Vermont. And when this statute was written, probably 600 years ago, no, not that long ago, but it was that simple. Like rent was contemplated as, something that you own a business in Essex or a building in Essex, and that's where it happens. But where that gets tricky when we're trying to look at this universe of operating partnerships now is that, well, what if you actually are a partner in a business that has 20 rental properties spread across 4 different states? That's a little bit different than source determining a rent. That's more of a business activity that's going to get subjected to apportionment. Or if you're a C corporation partner in said entity, that's almost definitely going to be apportionable because it's part of your apportionable business income. But so, one, rents and royalties, in the simple world and straightforward, that's going to be part of your taxable income in Vermont. Gains from the sale or exchange of property, so that's your capital gains piece there. All the same caveats apply to that as well. In many cases, it is as simple as, someone sold their tractor in Vermont that was, it's not a casual sale, let's assume. It happened in Vermont, it's taxable in Vermont. But there's a lot of cases where the analysis isn't going to be that simple and it's going to lead to a different result. Wages, salaries, commissions, and other income. Wages we're not as concerned with because that's not part of the business income in terms of our operating partnership and LLC income. And then here's where, kind of gets really interesting is number 4, the income from every business, trade, or occupation to the extent that that business is carried on in Vermont, right? So that is where we start talking about multi-state operations, where we say to the extent that. And we don't have anywhere in our pass-through statutes per se that says you're going to do apportionment the same way we have corporations. Like we have a statute and a regulation on corporate allocation. But what we're doing is we're saying when you have operations from a trade or business derived from every business, trade, or occupation, to the extent that that's carried on in Vermont, that's where we have to come up with some methodology of how to determine what's in Vermont and what's not. And we're using the same principles, laws, and regulations that we have on the books for C corporations. So then other stuff, we got goodwill, services. Most of this stuff isn't as relevant, but it's those first few that I wanted to highlight because those were the guiding principles when we put this 477 together, is knowing that in a much simpler world when we had no multi-level pass-throughs and everyone that was a partner in a Vermont partnership was like a human being, you could apply this stuff and it would work a lot better. Not always, but a lot better. But the world as it is in 2025 and even 2015 is not remotely like that. So, that's kind of where we're leading to when we get into the details of the BI 477. So there is 5823B. Thank you to whoever asked that question in the chat because it did lead me down to something I wanted to talk about anyway. And at that, I'm going to stop sharing right now.
There's a
So-
comment about the salt tax.
Yeah, I saw that. Yeah, I mean, it's, again, policy decisions that happen next door. We don't really have much influence or, you know, write your legislator if you want a PT tax. That's what I can say. Do you think it's a good idea? I guess I can talk for a minute or two about 5823B if you want.
Yeah, sure,
Okay.
please.
So, just to clarify what that statute is exactly, that is not Vermont's definition of taxable income for individuals.
Thank you.
I just wanted to make that clear. The definition of taxable income for individuals is how everybody that wants statute sections to take out your pen or start typing, I guess, is 581121. That's actually the taxable income for Vermonters. What that Vermont income number from 5823B is it's the numerator in what's effectively like a Vermont apportionment for non-residents. And that apportionment comes in through 5822E, I want to say, is what provides the numerator and the denominator. And basically the denominator is AGI, and the numerator is all those items that John just went through in that subsection B. So, you know, again, we're talking about something that's helping us build an apportionment number for individuals, and we're kind of identifying what the Vermont portion of that is. So it's an old statute, like John mentioned. States used to source all of this income back a long time ago with what they're calling now like rules of assignment or like geographic accounting, where you kind of take these various items of income and you kind of just source them under different rules. A lot of times it's situs, which situs is location, physical location. It's actually not that different if you think about it from what you know, modern rules for corporate sourcing are now. You know, if it's not apportionable income, then you typically source to the location of the income producing property, the physical location, which, you know, like the statute with rents, you look to where the actual rental property is. And then you would source passive income and tangibles. You'd usually source them to commercial domicile when there's no physical location that, you know, that is attached to that income producing asset itself, if it's not apportionable again. Yeah, they're not really that different, those rules. It's kind of, yes, it's just like a different presentation of how they're sort of, how they come nowadays. But yeah.
Yeah, I think from there, are we ready to jump into the 477?
Is everybody here with us so far? Following? Any
Making
questions?
sense?
Yeah.
Okay, so I'll bring the 477 up on my screen. I don't know if I'm going to share it the whole time, but I'd invite everyone that's online, if you have a second monitor, you could go to the department's website in the forms section. I don't know, Maud, is it putting you on the spot too much to point a link in the chat if you surf around?
I think I have it up. I can link it.
Okay, yeah. Actually, I could probably do that too. Or John, can you do that?
Yeah.
Yeah, so he'll give you the page where it goes through all the corporation or all the corporate and business income forms and instructions. And thanks to our comms team, they just got that done just this past week to get all the current stuff up. But again, you'll see kind of alphabetically in the list, the BI 477 and instructions are going to be the first one that we're going through. So let's go ahead, and I know I've got that already up here. Okay, and so, yeah, right in the title, and we are still actively soliciting suggestions for a more streamlined title to this schedule. We just did not get to that level of detail yet, but the Vermont, it's accurate if clunky, income adjustment calculation passed through Vermont sourcing. So I want to call out income adjustment here because, again, John was just talking about how it's not quite, it's basically an apportionment. We're trying to get to how much of this is Vermont and how much is federal. But the mechanism that we used was more like the income adjustment calculation that we do on personal income tax return for non-residents in Vermont. Again, as we worked our different ways through this, because this is mostly pointing towards non-resident individuals, it only made sense to use that same mechanism to try to get to the most accurate estimated payment requirements on that. So as we go through the schedule, you're going to see we're going to go through the sections first just at a high level, then go through a little bit more line by line, just again to get the whole purpose of the big structure. And that structure, again, is we started off by sort of breaking out those categories of income that we saw in 5823B, like those big buckets of income. So how much did the entity have, you know, everywhere, and then you have to determine how much of that is going to be attributable to Vermont. And so,
I think if you filed or you prepared a BI 477 previously and you haven't looked at this yet because it just got posted on Friday, which is totally understandable, you might be like, whoa, wait a second, that looks different. What we did was, it used to be organized trying to follow that statute that we've been talking about. It is now just organized as non-apportionable and apportionable.
yeah. We clustered a few of them together.
'Cause
With a couple of years looking at it, we realized we'd broken it out. That way it was a little confusing.
It was
Yeah.
confusing, and that's not really how people think about it, and that's
Yeah.
not even really how we think about it. So it was just easier to put them in this order where we just have, you know, one section for the non-apportionable income items. We have another section for the apportionable
Yeah,
income.
yeah,
So
and so I'm just going
I just wanted to draw attention to
Yeah,
that
thank you.
change.
So I'm going to roll through the sections at a high level first, then we'll go back. But just so we could see, because again, this is all going to feed down to where we're ultimately getting to that income adjustment, so that we can get to an amount of essentially Vermont taxable income. And I'll use that very loosely. That's not a legal definition in any way, but just the amount of income that we are going to subject to either composite income tax or the non-resident estimated payment requirement. So all those pieces are leading to that, which we'll get down to.
Yeah, one of the challenges with this, and John's kind of said it a few times already, but I'm just going to say it again in a different way, is, you know, for other tax types, you know, the starting point is a federal amount, right? For corporations, it's FTI, federal taxable income. For individuals, it's AGI, adjusted gross income. Those numbers are easy to get off of a federal form, because it's a lot of times, you know, what the tax is based on. With partnerships, because they're pass-throughs, the feds don't really report like an aggregate pass-through income on the pass-through entity level. So we have to build a tax base, a federal tax base even. You know, we have to take all those items on Schedule K that the partnership is distributing, and we have to add them all together. So to some extent, that's what this form is doing. It's creating a federal tax base for the pass-through entity, which is before when I was talking about PTE taxes. But again, it's not too far off of a PTE tax. If we had one, we'd probably use this form as well to calculate it on, you know, maybe there would be a couple little changes, but you know, that's kind of the bones of what this is. So I just wanted to throw that out there. That way,
Yeah.
Yeah.
Okay. So again, going through the parts or sections at a high level, and this is there's some changes this year from last year, but the overall construct, the idea of how this schedule is supposed to work hasn't changed significantly in the 2 years. It's just, again, making some of these improvements that we learned from the first couple of years. But so we've got all the apportionable income up top in part one.
non-apportionable.
Or I'm sorry, non-apportionable. Yes, thank you. Pass through non-apportionable income. We'll talk about this in detail, ability to make adjustments to those amounts. So these part two adjustments are only to non-apportionable. Then we go through items of apportionable income, and again, that's what's usually apportionable. It's possible that some of this income that is you know, kind of on the line is no, that is going to be source determined or allocable. So we have the opportunity to move that around, and then adjustments to the apportionable income. So part 5 is for the multi-tiered pass-throughs. So if you have income that is coming up from an entity that you own, that you're a partner in, that's where we're going to account for some of this, and we'll talk in a little more detail about when that income coming up, is that going to be considered non-business or directly allocable, or be treated as just a chunk of net income or loss, or is it part of a unitary or integrated business operation? And in the case that happens, that will end up in the apportionment factors and the apportionable income. So that's like kind of complicated stuff. We're going to get to that later on. It's, again, one of these things where if you are preparing for entities that don't have, have this structure, these ownerships, you don't have to worry about some of these parts of the schedule. And try to not get waylaid by it if it's not necessary. But it's that classic thing where like a large percentage of the complexity is for a very specific piece of the population. But we have to address it correctly, because as the business world has changed, like a significant amount of business is conducted through these entity types and passed around. Like what MTC? You said it's greater than 50% now as partnerships over pass-throughs versus C corps. Yeah,
is over 50%.
Yeah, and a lot of that volume is moving through multiple tiers being distributed around. So part 6 is where we get to that income adjustment calculation, where we're using mostly information that's higher up on the schedule to determine those everywhere denominator and the Vermont numerator to get to that adjustment that we're going to apply to the income amount. Part 8 is actually kind of a throwback. So this is where we're going to calculate the apportionment percentage, because going back up to the apportionable income, we start with the apportionment percentage for this pass-through entity. So we've kicked that further down. So everyone will probably, unless you just started your career last year or two, everyone else will remember that for time immemorial, Vermont used the schedule BA 402, the apportionment and allocation schedule, for both C corporations and the pass-through universe. And so what we're doing now is we've integrated that calculation into this schedule for the pass-throughs. So when we look down at part 8 here, is it 8? 7. This is almost identical to the existing BA 402, the apportionment schedule. We have one additional area where we're accounting for the apportionment factor of integrated or unitary lower tier entities. So if they're doing that properly, they're going to have that information pulling up here. But so that's going to arrive at an apportionment percentage that's going to inform the part that's higher up on apportionable income. And then just at the end, we have these couple sections. I'll just talk about them once here, and we're not going to really get back to that. But when we moved from a 3-factor apportionment to the single sales, legislature directed that the tax department collect information on the other 2 factors. So the companies are required to still report their wage factors for everywhere in Vermont and their property factors for everywhere in Vermont. I mean, most likely, obviously, so that we could do some data analysis and see what happened and what could have been. But so on our corporate apportionment schedule, that BA 402, these sections exist. They don't inform the actual calculation, but we're gathering the data. And so we've included these sections here as well. And these are only for if you have a corporate partner or shareholder or owner somewhere up the chain. You would include those numbers so that in theory, if that corporation is completing its BA 402 accurately, it now has the information from the entities that it owns to actually do that information. So that's like kind of the sole purpose of these pieces right here. So again, it's another example where to be in compliance with what the legislature wants us to do, we need to put this here. We know a large, a large number of the folks that are participating, that are joining us here, you're not going to have to do this for your basic partnerships that don't have a corporate owner. So I'm not sure.
I think the instructions are clearly.
We tried to be clear.
Because there's been some confusion with that
Yeah.
over the years too, so it's an important thing to talk about.
Yeah, but so again, that's the high level. We have these different buckets of income: the apportionable or the non-apportionable, then the apportionable. What's coming up from pass-throughs, all of this is to construct the income adjustment and get the federal and Vermont income amounts so that we could determine the correct tax base. And from there, I don't know, John, do you want to take the lead on going through some of the specifics?
Sure.
Okay.
I could.
Do you want to use my computer, or you got it right there? I'll follow along.
Sure.
Okay, well, I guess let me pause, let's give it a 15 or 20-second pause to see if there are any questions or comments. Again, we're all in big picture territory here, but the point that we keep driving this home, and this very much comes from supporting our corporate and business income tax team, is when you get these super specific nuanced questions, it's always helpful for us to what are we trying to achieve here? Back out, where does this fit in? And that helps us provide, the best guidance and the best answer. So again, I'm, just emphasizing over and over again the big construct of the schedules. Looks like nothing's coming through. All right, we'll dive right into the lines.
Do you, so we're 15 minutes in, do you think, do we want to give people a break for 2 hours? Or can people make it?
Oh,
all right.
Exciting. Yeah, here, let's look at those. Do we want to take a break, a 5-minute break at 1 hour in?
Sure.
Okay, yeah, let's do these questions, and then that'll be a clean break, and we'll go line by line through the 477.
Actually,
Yeah. So can you read those out loud? Or I'll read it, I can see it actually.
Okay.
Why would line 40 be completed for gross rents when rents are included in part 1 for non-apportionable income calculation? So let's just table that, because we're going to go through this line by line, and we'll just kind of remember when we get down to line 40 there. And
what is line?
Let's see what line 40 is. Yeah, just so we. Yeah, the line 40 is gross rents. All right, that one's easy, so we will answer. So the sales and receipts factor, again, to kind of repeat what I had said in. Oh, actually, no, this isn't a repeat, because this is the actual apportionment.
Yeah.
So we'll go into this in more detail in a minute, but the very short answer is in part 1, we're developing an amount of income, and in the apportionment factor, we're determining, based on all the operating apportionable income, is what percentage of activity is happening in Vermont as opposed to everywhere. So all of these numbers in Part 7, including line 40, these aren't getting added to income again. These are to construct a percentage of Vermont versus everywhere for that subset of income which is apportionable.
In our, we have very dense apportionment regulations now that I can share the link in the chat in a minute, that kind of walks you through when you have gross rents that are included in the apportionment factor. If you go through that and you kind of determine that your client does in fact have gross rents that belong in the numerator and the denominator, that might actually be a really good sign that you need to recharacter some of the income in part 1 as non-apportionable and make it apportionable. That I think answers the question on a high level. I don't know if that could also just come out as Greek to people if they're not familiar with. So basically we were talking before that we kind of looked at the items of income that were being identified and distributed on Schedule K, and because we had to add them all up anyway to come up with a federal tax base to work off of, we kind of came up with these default categories, and we were like, this is more often than not non-apportionable income. This type of income is more often than not apportionable income. So we kind of put them into those 2 sections that John just walked through a few minutes ago. But like John was saying, that's not always the case. You kind of have to look at what the business is doing itself. So if the business is in the business of renting properties, then it's probably not all going to be non-apportionable for that particular filer. Some of it is going to be apportionable. So you're going to have to make a debit out of that section and under the recharacterization line, which we can get to in a few minutes, and then make a credit into the other section, the apportionable income section. So you're basically recharacterizing it from our default classification as non-apportionable, and you're making it apportionable, so then you're going to source it properly. what probably shouldn't happen is including lots of numbers in the apportionment factor in Part 7 that are not also in Part 3, which are the apportionable income. I think that
Yeah, no, I think
that-
that does, and yeah, I'll mention now, and we'll talk a little bit more about it now and when we summarize this really, kind of big picture thing of which income is apportionable and which is non-apportionable. And that's really the distinction in the language, the multi-state language, because we used to do apportionable versus allocable. We used to call it business and non-business. And again, a lot of these things are saying almost the same thing, but I do want to try to be really specific because it does matter. Source determined is a word that's being used a lot now. But again, for our purposes now, and pursuant to our regulation, which is what's actually important for us, is that income is either going to be in that apportionable bucket of what your integrated business activity is, or a shrinking amount these days is really non-apportionable or directly allocated. But it's, and this is like a really important point to emphasize, and we'll come back to it again. When a activity or transaction takes place at this business level, at the operating partnership or S corp that we're preparing the tax return for, the business and preparer have to take a position and say this is either apportionable or non-apportionable, right? And hopefully it's clear. There's definitely gray areas. There's a lot of gray area, but that determination has to be made, and that's going to inform how you complete the schedule. Like, we, the tax department, can't do that for you when we're just looking at a piece of paper. We could certainly provide guidance based on our regulations and based on other common practices. But once activity is carried out at the operating level and it's determined to be either part of the apportionable bucket or a non-apportionable piece, that characteristic kind of stays through as it's passed up and through.
Yeah, you don't
And
get to
it's not that complicated when you only have that one tier of ownership, where even if you have some individuals and some C corporations, you're saying, like, we did this activity, this is going to be allocated to you, John Doe. You're an individual, this was allocated income, it's going to go into 5823B, it's going to land as a whole number, not part of an apportionment bucket. Or you, Acme Corporation, this is going to be in your non-apportioned allocated income. But that determination is made at the operating level, right? So we'll, kind of let that sit in a little bit. But that's like important, especially for when we start getting multiple tiers of passing through. And as we had, a lot of conversations over the last couple of years with preparers in our region, some of the firms in Vermont here that do a lot of returns and run into a lot of this stuff, but also with some partners from Big Four type accounting firms where they're a lot more concerned where what happens when it goes up through 3, 5, 7 levels, and like how are we accounting for that and what kind of direction. So again, one of the challenges, we're trying to be all things to all partnerships on this, and from the mom and pop right through the multi-billion-dollar org chart is like a spaghetti pie thing. But regardless of who you are, when we conduct business, is it in your apportionable bucket or is it in your source determined or non-apportionable bucket? Remember that as like a foundational kind of takeaway. And we have a takeaway sheet that will circulate like probably after Thursday, but that's one of the things we do call out to highlight. Because that, again, like pulling back the big picture, it's like, well, where does it land on the schedule? Then how do I get the math right? You have to answer that question first so we know where to put it. Right? But so for now, I guess I'll reshare my screen and we can get going in detail on the 477.
Did you want to address Seth's question, which was just a general question about apportionment? If you could give-
Sure, let me scroll up and take a look so I can see that.
the example of apportionable, what is non-apportionable.
Oh, yeah.
I can, let's pull up the form and then I can kind of incorporate that in.
So we got interest, lower tier, this CZ is a really good question.
Yeah, that's a little bit more complicated though. We'll get to that.
All right, if you could give a simple example of what is apportionable, okay, what is not apportionable. Yeah, that's a good thing to do up front, I think, just so that people have a similar groundwork. And let me bring up the schedule. Okay. Do you want to do the basic definition of apportionable versus non-apportionable?
Sure.
All right.
Yeah. So basically, the definition of non-apportionable is anything that isn't apportionable.
Love it.
That's always, but I'm not trying. I know that's a little.
It's a little cheeky, John.
Yeah,
a little
I'm not trying to be cheeky.
But that's also what it says in the law.
Yeah, and so if you look at those apportionment regs that I mentioned earlier, that I realize I still have not dropped the link into the chat. Let me do that right now.
Yeah.
They are very helpful, and there's basically two tests that each business has to perform, think about, analyze the income that they're receiving.
Yeah, but wait, before John gets all constitutional on us here, which I think I see where this is going, really basically put almost all of a business income is going to be apportionable.
Yeah.
Usually. Like everything's apportionable. Like if you're conducting a business, like whatever it is you're doing, if you're making widgets, like all the things that are involved in that are going to be part of your apportionable business. If you're vertically integrating and you're making widgets and you're distributing widgets and you're retailing widgets and you have a mail order widget business, like everything you do that's like along the lines of that, that's going to be within your apportionable income base. And the way our regulation is in many, many states, like practice is going, less and less things are being determined as non-apportionable than apportionable. Like traditionally, going back years, like examples would be, sitting on capital that is you're not using for a business purpose, you're just holding on to it and it's generating interest. That would be non-apportionable, for example. An example again from years ago is, this widget, this massive widget conglomerate that's doing all its stuff. The corporation also owns a vacation house in Colorado that the executives go to once in a while. You sell the house, there's a capital gain on that. That might not be apportionable because it has nothing to do with the business. That's like kind of super basic examples, but now John could provide a little bit of the theory and the tests on that.
Yeah, and if you look at the regs, which I don't look at them now unless you're really that interested, on your own time at some point. If you look through like the first 10 pages of those regs, there's a lot of information in there about how you figure out what is apportionable income. And there's these two tests that you run in the analysis. One's called the transactional test and one's called the functional test. And basically what those tests do is to look at the income or the income producing item and kind of deciding how integral it is into your business. Like John said earlier, if you have, and this kind of answers one of the questions about when you would recharacterize the interest and the dividend income into part one. If you're really just sitting on a passive investment, maybe you had extra money, extra cash on hand, and put into some sort of municipal bonds or put into some sort of company stock, that it's just sitting there. That way it's not in a bank account somewhere, but you could fairly access it quickly as liquid if you needed to. Maybe that would be passive income, and maybe that would be not apportionable. Another thing that would be not apportionable is if you're, and John kind of just said this with the Colorado example, but maybe your business owns a building that it operates out of, and eventually it kind of decides to sell the building. It doesn't want to own it anymore. It'd be better off leasing it or finding a new place. So it sells the warehouse. If your business isn't in the business of selling warehouses, that one-time income, that one-time capital gain might be not apportionable, and you would maybe source that to the location of the warehouse, something like that. But the transactional and functional tests are really they seem simple when you read them, and a lot of times they're fairly straightforward, but like any other legal analysis, there's always a bunch of gray and a bunch of questions. And if you're preparing tax returns and you're really having a hard time figuring out apportionable, non-apportionable income, I would say consult an attorney. That's best as I could provide as an answer for that. But the analysis that you need though is in those first 10 pages of the regs.
Yeah.
So,
Yeah, and again, to further that example that John gave of a company selling its warehouse, like it could get as nuanced as, and you know, a lot of times when these get contentious, when there's like big tax dollars on the line, you know, tax law is made through the courts. And obviously as tax administrators, we don't want to do that. We want to give people good advice and just like not have to go through all that. But, you know, I remember from various kind of seminars and trainings that there's a determination. All right, so if you're using this warehouse for your company's business and warehouse, that purpose, right up to the point where you sell it, that's something that's used in your line of business, and the capital gain on that therefore falls into your apportionable bucket. You could get to a nuance where, okay, you're using the warehouse, then at some point you make a determination, we don't need to use this warehouse for our business, we're gonna lease it to a completely unrelated party. You lease it to an unrelated party for a couple of years, just because you could do something and get some revenue. Then you sell it. Then that capital gain could more likely be considered non-apportionable because the company has not been using it in its line of business for a period of time. It hasn't been part of the main business activity of, you know, selling widgets or whatever you're doing. It's just a separate asset. But, you know, when you get down to it, it gets, you know, down to facts and circumstances like that. And again, if you have, like John said, if you have like a really big money decision hinging on this, like one thing you want to do is be thinking about it beforehand, not after, and, you know, really, you know, do some legal research. What if similar cases, similar fact patterns come out of, if it's not, you know, black and white in our regulation?
Yeah. And I see another question about rental income for multiple states with this being non-apportionable income. And again, it depends.
Yeah.
You have to see what the business is doing. I can't give you a black and white answer.
Yeah, I was just working on, do you mind if I jump in on that one?
Yeah.
Because that's like one of the ones I always like to use, and it really just highlights from simple to complex what we're doing. So let's say we have a partnership that's operating in Vermont, and there's one owner is a non-resident individual and another owner is a C corporation. Maybe there's some more owners too, but we'll just talk about two of these to make a distinction. So this one partnership only owns one property in Vermont and it rents it. And as that flows through to this individual partner owner, there's a pretty good argument that that is going to be non-apportionable or directly sourced. Remember that first clause in 5823B is money from rents or royalties. If that's the only business that this partnership is in, it's just literally like one property, that's, you know, it's kind of pretty straightforward that that's a property that's in Vermont, there's nothing to apportion for this one individual. But now let's say you're the C corporation and you actually own a piece of 20 such partnerships, right? You have real estate properties in multiple different states. You, from your corporate offices, you have common accounting functions, maybe you market the places together. Like from there, that looks, I mean, it doesn't just look like, that's apportionable business. You're in a kind of activity that's shared and distributed, there's common resources, you know, and efficiencies where that becomes apportionable. So again, you know, and then kind of like the additional flavor of that might be if, let's forget about the corporation now, but you just have some individual partners that have a partnership that owns multiple properties, you know, in multiple jurisdictions. I think in a lot of cases you make an argument that that's going to be not just a rental income, but that's income from a trade or business, which was in that third or fourth clause there, and we'd call that apportionable. And again, there's room for nuance there, you know, and figure it out. But like, in general, if you're doing like a coordinated thing, a coordinated business activity across multiple states, that looks more like a trade or business than a standalone rental activity. So that's kind of, you know, a take on an example for that. Oh, and I got a thumbs up, so hopefully that was somewhat helpful. All right, great. All right, so that's like line one right there, net real estate income. From there, we're gonna take that as a launching point to start going through these lines. John,
All right,
you
well,
wanna
so-
take it from there? And then we'll get to
Yeah.
that recharacterization line, because that's where that becomes key. But let's run through these. A lot of them are pretty self-explanatory, but go for it.
Why is this? Maybe I never plugged in my.
You're not plugged in.
Oh, okay.
Here, let me-
Oh, well, that would help. Thanks.
Doing some
All right,
tech
well, John's
support.
doing that. We've gotten some questions over the last couple of years about why the 477 is required. Basically, we need to require it whenever we need to calculate the partnership's income, which means that we're either doing a non-resident withholding or we're doing a composite tax based on the partnership's total income. As I said earlier, there's not a number anywhere we can point to on a federal form where we say, hey, this is like total taxable income for the partnership, because subchapter K and federal forms are all about distributing income items to the individual owners. So basically what this form is doing is kind of aggregating all those federal numbers together to come up with a total, and then it's sourcing all that. The two pieces that we need from the state's perspective is we need the income sourced, and we also need what I'm going to be referring to as modifiers. We refer to them as adjustments on this form. But basically the changes that Vermont's doing to federal dollars, and we need to account for those as well. So we need to start with the federal the federal total, and then we need to make the modifications to it, and then we need to source it to kind of get what the tax base is in Vermont. I want to, even before we talk about part one, I want to talk about that, the check box, if you can just scroll up, John, just for a moment. Up, yeah. So we added this new this year. There are pass-throughs that basically just exist within Vermont. They don't really have multi-state activities, but what they do have are owners in other states, which puts them into the category of needing to do NRW or needing to do a composite return. And so we understand that column A and column B kind of become superfluous for the businesses that just have Vermont activity. So we added this year. If you only have Vermont activity, check yes, and then column A should just match column B. I don't think we have a way that it automatically populates that right now, but everything should match. And that's an easier way to fill out this form, right? Because we were getting questions, we've gotten questions about that over the years. Okay, so anyway, so let's start with part one. Even though they're not in the exact order of Schedule K, these are the same items of income that are on Schedule K. So column A should match, for the most part, Schedule K on the federal returns. If you have net rental real estate income, if you have 1,000 reported on Schedule K, you're probably going to have 1,000 reported on line 1A. And all of these lines are going to follow like that, where it's just going to pick up the Schedule K number for the most part. So that's the first 8 lines, right? And again, these lines were the ones that we kind of identified are more often than not, when we see them, non-apportionable to a business. That doesn't mean that there can't be values included on those lines that actually are apportionable for that particular business. It's just that we just needed to come up with a default characterization to put them somewhere. So those are the items that are in part one. Line 9 is a recharacterization line, and that's really important. There's another recharacterization line in part 3, the apportionable section, and the way you should kind of look at those recharacterization lines is look at them as like a debit and a credit. So if
could I just jump in real quick to be really clear? What we're What John's saying is absolutely correct, and it's like the detail of how it works. But what we're recharacterizing is the nature of income from apportionable to non-apportionable.
Yeah.
So if you get into that situation where I was making up an example before, where you have an individual, like let's say your net rental income is $100,000 for the year, and $20,000 is going to an individual and $80,000 is going to a corporation. But you know for the individual it's going to be non-apportionable, but you know for the corporation it's going to be apportionable, right? And that could lead you to some absurd results in a calculation of either a composite tax or non-resident estimated payments. If you want to be nuanced and get that exactly right, you could take that $100,000 and treat it as partly as non-apportionable and partly as apportionable. That's like kind of the whole purpose of these lines, is to get as close an estimate as possible for your different ownership types. So again, it's the characterization of income as apportionable or non-apportionable that we're creating some flexibility here with. And so you want to go on about how the debits and credits work. Yeah.
So basically, if there's values that are included in column A that should not be non-apportionable, that should be apportionable instead, what you would do is you'd subtract them out on line 9A. Again, almost like a debit credit, where and anything that you subtract out on line 9 then needs to be added on the corresponding line in part 3 of 20A, right? So if you subtract 900 out of part 1 here, you're going to have to add 900 on 20A.
Yeah, the income doesn't disappear, it just gets recharacterized.
Basically, you shouldn't source the money that you know you're going to back out. So there shouldn't be a need for a negative on 9B to back out income that's included in column B above it, because let's hope you're not sourcing stuff using those rules and then having to back that out. You could just leave it off that line, or off the line that you know you're going to remove it from. In column B, don't bother sourcing it. And so what's going to happen then, you also need to take any numbers that you subtract out of part 3 on line 20A, and you need to add that back into line 9. So you're going to have these negatives from lines 1A through 8A. You're going to be removing values on line 9A, and you're also going to be adding in values that you removed from the part 3 column A, and you're going to add that in. Now, that might come to like a change of 200, or it might a change of 8,000, or a million. Who knows? Whatever the amount is, at the end of the day, when you add and you subtract all of those values together, that's how line 9 and line 20A work. Line 9B will actually include positive additions from the money that's coming in from part 3. So what I mean by that is, let's say you're in part 3 and you have all this apportionable income. Like I saw there's a question before about interest. So I'm just going to use that as an example, right? So let's say interest is included in part 3 as apportionable as its default rule, but we were talking before about truly passive income. It's just sitting there maybe in stock market, I don't know. And you're like, this is not really connected to my business. This is just something we do with our cash flow. It's not apportionable. It should be non-apportionable. What you would do is you back out the number from interest. Let's say it was $100 of interest. You'd have a negative 100 on line 20A, and you have a positive 100 on line 9A. And then what you're going to have to do is whatever that 100 is that's coming in, you're going to have to apply the sourcing rule that's appropriate to get a value on 9B. So for interest, it's typically sourced to the state of commercial domicile. So let's just say, for a hypothetical sake, that it's a Vermont domicile business. So now that interest is sourced to the state of commercial domicile and it's Vermont. So then there would need to be a corresponding $100 addition on 9B. because the income would be sourced through Vermont. And it needs to be accounted for on that somewhere in here. So that's a really rudimentary example, but I think that kind of gets the point across. And maybe in your head you're like, well, we're going to have all of these kind of, it's going to be a bunch of additions and subtractions, the values will be a lot more. Yeah, they will be. And so we're just kind of seeing the totals on lines 9 and 20. I'm pretty sure we require an attachment. If you have a value on line 9 or 20, I'm pretty sure it won't even let you file.
We're going to be working on that a little bit more as to which of these lines are going to require a statement for MEF going forward. Admittedly, we're like at the rudimentary stages of doing that, but for any of these lines where we're kind of recharacterizing or other, like there's a couple spots left over where it says specify on there. We're not going to have that, but we're going to try to create it so that the statement is required and attached, so you have the opportunity to tell us what's going on there. There were a couple questions. Maud, can you scroll up just a little bit? Or actually, I have the ability to do this myself. Sorry. When would interest and dividends be allocated? I hope we just talked about that a little bit. Like they're often going to be allocated when they're unconnected to the main thrust of your business. Yeah. But then there's let me just say, because Tim has a much more nuanced question about the ERC, and I want to propose that maybe Maud or someone could take that down, because I don't want to wing that off the top of my head right here. That's a good question, and if it's a real question, we will, kind of not just for a hypothetical sake, we'll take a look at that and get back to you, but not, kind of figure that out on our feet right here.
So to Matt's question.
That was the other one I was going to say, the question about when would this be.
So the question is, when would interest and dividends be taxed to a VT non-resident? Interest and dividends are taxed to resident state. That is true for the most part when the interest and dividends are actually integrated into the business and is part of the business operations through the functional test and the transactional test. It's considered business income under subsection 4 and would be taxed under formulary apportionment, basically. There in those regs I sent earlier, the link to, it talks about it, because actually the same conundrum somebody was identifying before of like, why do you have gross rents as not apportionable, because it's included in the factor apportionment part of part 7. There's actually, if you scroll down, you can see that there's a line for apportionable interest and dividends. And so I think my answer to that would be, if you have a number that's on that line, that should probably tell you that there needs to be some sort of apportionable interest or dividends. Again, it's the analysis, the regs walk you through it, of when to include the interest and the dividend income. And that's a good question, because I remember we took that like a year ago or so, and we were like, you're right. And then, the preparer just made a case where that it was going to be taxable in this way. And so again, a lot of the flexibility we put in this form are in response to actual questions we got. And 1 second, yes. And there are definitely going to be outliers there. And some of these things are accounting for outliers. So if you're going through the course of your business, your whole client base, you're like, what's this line for? Like, you don't have to seek out a business use for these lines. Like, you might never encounter some of those, and that's great. Like, it's like, and especially if we're starting with, simpler organizational structures, like really simple partnerships. Like, if there are lines on here that you think, I don't think these apply to my business, they probably don't apply to your business. And, you don't have to kind of overcomplicate your lives with those. I don't mean that dismissively, because again, this whole universe is pretty complicated, but a lot of these lines are acknowledged to provide that flexibility to outlier scenarios, where in years past, like, we'd have people calling in, it's like, how do I do this? And we'd be looking at our schedules like, I don't know how you do this. Like, we want to provide the ability to do this. So we do have a question in the room, or a comment in the room.
And maybe this wait till Thursday, I don't know, with your software vendor corresponders. you giving guidance to the software vendors of what the default is, or is it going to be totally blank and we've got to do a bunch of overrides in the software, or is it going to be, hey, default to apportionable, then the repairer will reallocate it to non-apportionable if applicable?
Yeah, let's have that conversation Thursday, because my kind of knowledge of interactions with the 20 some odd software companies we have are more about what kinds of numbers and values are going in there, not at the level of the software companies making determinations on allocable versus apportionable. That is something that if we could make headway on that over the next tax season, couple of seasons, that sounds great, and we'd love to engage with that, so that the software and the MEF schema that it's all coming through can throw red flags to make sure we're getting things that make sense. But let's talk about that more on, will you be back in the room on Thursday too? Or even if you're online, just post it online.
Yeah.
We'll have that conversation, and then maybe even take it offline more, because if there's more we could be doing in that area, we'd definitely carry that torch.
Yeah. So there's another question about investment partnerships. I'm going to put a pin in that until we get to the more complex structures.
Yep.
Okay, so just scroll back up, John, to the first page. And so,
and just to be aware, we're 25 minutes left, so well, we'll carry over to the next session.
But we can get through this form, I think, for the most part.
Yeah.
So everything that's listed, the income that ends up getting reported in part one is going, and the instructions make this clear, it's going to be sourced using most part rules of situs, some commercial domicile perhaps, location of certain assets. I guess it depends on the instructions make it clear what rule you're going to use to do that. So all right, now we can go down.
Yep. So the adjustments.
Yeah, and so this is the other thing that we need this form to do is basically take federal money and make it into what the Vermont tax base is. It's right now we broke out bonus depreciation because that's the one that comes the most often, and we wanted to track it separately. So that's just its own line on 11, and then line 12 is basically all other adjustments that our law requires, and the instructions kind of walk you through a few more. There's the salt and local, state and local tax add back that we get a lot of questions about. That goes on that line, and there's a couple of other types of things that could go on there. The good news is if there's more stuff in the future that needs to go on there, we can just put it on there.
Yeah.
We don't have to have its own line. But I believe if you put stuff on that line, you need to attach a schedule as well, because we realize that it's kind of just like a bucket for people to just report all these various things.
And again, the use of these lines, especially if we're not doing a composite return, if it's a true pass-through entity, these are all in service of getting you to the correct estimated payments, because it's those persons or corporations that are going to be applying the appropriate tax laws. So if there's no such, not really bonus depreciation at the partnership entity level. Like the transaction happens, it all gets split out. But if you have either, if you have to make an adjustment for Vermont, either for that, big add back in the out years, or add back in the first year, or, talking myself in circles on the bonus depreciation as I have been for 20 years. But it's just to get that number closer to what your corporate or individual partners are going to actually be paying taxes on. And under Vermont law, we've disallowed bonus for both for time immemorial now.
Yeah.
So same thing with these here.
Yeah, there's a question here. It says in column B, in part 2, it says for Vermont source income above. Meaning part 1, yes. That's kind of what you're going to be doing is you're basically adjusting the dollars that are being reported in part 1. And so, I don't know, coming up with
because this part is going to net down into that income adjustment piece, because again we're going to have the numerators and denominators. This is the non-apportionable chunks that just are going to come in as kind of whole numbers to the Vermont numerator, and so this is where you can make adjustments to those numbers.
Let's say your widget business has a bunch of pieces of machinery that it has bonus depreciation on, I don't even know if you can take bonus depreciation on machinery, but whatever. Let's say you did, and let's say you decided to sell that machinery, like I was saying earlier, where it's a one-time sale. You're not in the business of selling that machinery, you're in the business of making and selling widgets. Maybe you sell, and maybe that piece of machinery is located, I don't know, somewhere else in Wisconsin. You basically sell that piece of machinery, you report the whatever gain you get from it above as non-apportionable, and then you sort of zero that into Vermont because it was, located in Wisconsin. So we have a bonus depreciation adjustment for it. Possibly, let's say you were doing bonus depreciation for it, and we've been adjusting for it in previous years. But now there's like that one-time lump sum adjustment. You would put that value there, and then you would source it. I guess the example of Wisconsin isn't very good because you're not going to source that to Vermont. Let's say the piece of machinery was in Vermont, then you would do the one-time adjustment on that Vermont value that's being included on, was it line 2A or 3A or whatever it is. You would make the adjustment on that line basically. That's the idea.
Yep.
Yeah.
Okay. So the apportionable income
Okay.
pieces, right?
So now,
Just
now
jump to that.
we're into
So
yeah.
line 13, we're going to get down to that. That's where you've calculated an apportionment percentage, pretty much exactly the way you would do for corporations. Well, that's something we'll only run through in a cursory fashion because it's fairly straightforward.
Yeah.
But before you've done this part, you've done this calculation. The first couple of years we had the schedule, that's been a pain point in how some of the software has worked. So if anyone has had issues with that, thank you for your patience on that. And thanks to our team for administering that. But the idea is you do the apportionment percentage first down below, and then it feeds through here. So here's
So this is the remainder of the income items that are from Schedule K. And again, the column A should pretty much match whatever the Schedule K amounts are. The exception to that might be the line 19, the other deductions. That's a new line that that's in a reference to, and the instructions make it clear. I think it's line 13 on the Schedule K 1065 and maybe line 12 for the 1120S, I forget. But there's basically this other deductions line on Schedule K where there's a lot of different deductions that could be included on that line, a lot of different codes in the federal instructions. You're going to have to look at what's being reported on the federal level and make sure that Vermont, that deduction is eligible in Vermont. And it might be like, for instance, if you have a lot of residents or a lot of individuals as partners, as owners, and it's a deduction that's below the line, that's not part of AGI, then that's not going to be a deduction that's going to flow through to Vermont, through Vermont's conformity. So you're not going to include that value on line 19 at all, because it's just not, part of where Vermont picks up. So that's why that line might not match the federal Schedule K. And it's really complicated as far as having all the different, there's so many codes and so many different deductions. If you're preparing a return that has that, you're just going to have to go through it and do the analysis of each one and say, what is this? Is it above the line, below the line? Is it only available to corporations? And kind of figure out what part of the amount being reported on the federal level gets to be on column A, on line 19. And then, as I said before, I talked about line 20 a little bit. That's the recharacterization line. One difference with the recharacterization line is column B in this part is populated entirely by multiplication. So if there's ordinary business income or investment or interest income that's being reported on 15A, there's going to be a number reported on 15B, even if you're recharacterizing it. So those amounts, though, are going to be backed out when you just end up doing the multiplication on line 21A. So if you follow the math through, what you end up having is when you have, or on line 20A, sorry. So when you follow the math through and you have all of the additions to part 3 and all of the subtractions from part 3, and you end up multiplying whatever's on 20A by the apportionment factor, it'll give you the adjustment that you need on 20B. Again, I guess to keep it simple, just it's all multiplication. Don't start altering things in column B. It's all going to be zeroed out basically at the end through math. So that's that part,
Yeah,
right?
I think that's pretty good.
And-
Yeah, well, let it sink in. I see,
Yeah.
question. So there's a question on investment partnership that it seems like people are really curious
Yeah.
on there.
So
So it has interest, dividends,
I'll-
capital gains, but no business. So there's some nuance right there,
Yeah.
first of all. Do non-residents have to pay tax on
So
this income?
the non-residents, this is the thing, is like that income is going to be, if the investment partnership's really just a shell and there's nothing there, then those businesses will already have submitted, like the actual income earning businesses that investment partnership is owning will have already submitted non-resident withholdings, will have already submitted composite on the actual business activity that happened on those levels. So yeah, everything will flow up, but it's been kind of paid for already, and it's been sourced, like John was saying before. When you source it once. You don't get to resource it over and over again. You source it once on the level that's incurring the
Yeah, but I wonder if
income
this
to begin with.
question, and maybe we could get some clarity, is not like an investment partnership that's investing in like active businesses, like it's not like a venture capital, but is it just like a group of people that are investing in a mutual fund or stocks or something like that?
Yeah.
Like,
Well-
like old school, like.
So then
because-
that's already, I'm seeing the next question was, what if it's from a 1099 and not connected to a PTA? Okay, so then it does have business activity on that level. It's actually incurring a direct investment, which is different than having factors flow up into it. So then you're going to have to kind of look at, so now that level of business is going to have to do the same analysis of deciding whether or not that particular type of income, say investment income here, is part of its business, and then it's going to have to source it accordingly. That's the way it'll work.
Right, yeah, so I see again, it's like, looks like we're focusing on kind of a specific fact pattern.
Yeah.
And if that's the case, we could take this offline, we could, kind of write in and we'll do our best to give a determination.
Yeah.
But, I'm looking at it like at two different polar areas and obviously there's like a whole spectrum in between. If it's like a couple people that are employed full-time doing other things and they created a partnership just to kind of pool their money, have some fun, make a little money, learn the markets, that's what our investment partnership is. I could get to a kind of result there where that would be all probably allocable to situs if it's or your domicile or residency, if it's like kind of a thing you're doing and there's no physical activity. But if this is like an investment partnership that's a full-time business with professional offices, and this is what you're doing, and you're moving around a lot of money, and you're investing as your livelihood and that of other people, then you're in the world of you're actually running a business, and your investments, wherever they are, might somehow land in a more apportionable bucket because you're in the trade or business of investing and earning money.
Yeah.
So I mean, it depends. You need to see the exact facts and circumstances
Right. 'Cause
of what's going on.
My question to this is, if it's a bunch of non-resident individuals that are owning an investment partnership that has no activity on that level, why is it filing a Vermont return? Like, what's the nexus
Yeah, I know.
for it? I guess maybe if it's receiving income from a partnership, a lower tier that had nexus, then it's receiving some sort of Vermont like income source from that lower tier. But again, that lower tier is probably already remitted payment on the Vermont portion of that income on its own 477. So yeah, but you're right, like if there's interest that an investment that's directly incurred on a 1099 by that level, now it has Vermont nexus, you have to do the analysis of, is this apportionable income or is this non-allocable income, or non-apportionable income, sorry. And if it's a business that's operating and, you know, maybe that is apportionable, and then maybe it needs to do its own, it needs to apportion that, you know, using its factors, and like you would have to do the factors and figure out what portion of that ends up going to Vermont for all the non-resident owners. Like that's the analysis. I know that was a lot
Right, yeah, and that's
through,
but again, if we
what
could
you have
walk
to do.
it back to like sort of the simple example that I was hypothesizing, it's just like a handful of people that it's as much a hobby as an you know, it's like you could get to a point where that just all goes to residency.
Yeah,
if it's
well,
just like kind of publicly traded stocks and stuff.
And I think
right?
like, let's say your
Is
example
it-
where you have like a bunch of non-residents, right? Let's say they're all non-residents. Let's say they all live in Maine and New Hampshire. I'm kind of like, well, why are they finally here to begin
maybe
with?
one of the partners
Maybe one
lives
of them
here.
is in Vermont. Yeah.
Okay.
Okay. Yeah. So anyway, so part 4.
Yep.
And we can maybe, when we talk about tiered structures a little bit later, or on Thursday, we can talk a little bit more about that investment partnership scenario. So
But again, we got 10 minutes left, so let's blaze through part 4 because
Yep.
it's similar, and then get into 5 if you want to.
um,
I mean, part 4 is kind of the same as we went above in part 2. It's the ability to make adjustments to this bucket of income. Bonus depreciation being the big one, and then other things where Vermont's definitions either call for some different treatment, or you know, where we've specifically decoupled, and you know, there's the whole you know, recent tax bill that the legislature is going to unpack this session. But you know, right now we're where we're at. Don't want to do that can of worms today. That's a whole nother symposium.
These adjustments are just the ones that correspond to the income items reported above in part 3. So it's the other part of the modifications.
Right, and so let's circle back to part 5 to kick off on Thursday, because that's more than 10 minutes worth of information right there. But I think this is 10 minutes of information, because it's pretty foundational. And so this is the part where we're taking the you know, the everywhere and Vermont pieces of apportionable and non-apportionable income to figure out how much of it is going to be attributed to Vermont. Do you want to walk through that a little bit? Or do you want me to, go for it.
Well, I mean, I've been talking this whole time about how we need to calculate federal totals, right? Because the feds don't do it for us. So that's what this section's doing. At one point we call one of the lines AGI equivalent. But it's not AGI, it's not FTI, it's just these totaling federal dollars and Vermont dollars.
Again, why is this like so kind of Byzantine? It's like we did our best with the wording and acronym, but it's true. Like the real sincere answer is because we went back to how do we tax non-resident income? And we come up with that income adjustment, and that's what this is closest to. It's because we're taking apportionable and non-apportionable to get to this point. So when we used like the federal adjusted gross income, you know, we kind of landed on, well, it's kind of like that on the personal income tax return. It's not that, so we don't want to use the exact phrasing, but we had to come up with something. But conceptually, if you do a lot of Vermont personal income tax returns for non-residents, it's kind of in that ballpark, or it's more than in the ballpark. It's a lot more like that than anything else.
And basically what this section's doing, and it's all math, you just follow the instructions, is it's coming up with a federal total from column A, and then it's coming up with a total Vermont modifications from column A, and it's basically applying those modifications to the federal everywhere numbers and getting an adjusted federal number that's a total federal dollars, and then which is everywhere, and then you're doing the same thing with Vermont where you're coming up with the entire Vermont source total, then you're applying the adjustments as they apply to a Vermont money, and then that gives you a Vermont income with adjustments, and then we're going to use that as a numerator, and we use the federal dollars as a denominator, and that's going to give us an apportionment percentage that's then going to be applied on the composite return on the 473. So if you're doing a 472, if you're doing non-resident withholding, it's just going to be the Vermont totals that we're just going to base the percentage off of.
So that's kind of it there. From here, we're feeding through to the 472 and 473. Again, not that different and simplified, because you'll all recall in prior years going back a decade and a half, is that we kind of kept building these adjustment figures into the 472 and 473, creating like a, Frankenstein of tax forms. But now we're trying to do the vast majority, if not all of that, on the 477. So the 472 and 473 get much more streamlined. And I believe we still left an opportunity for an adjustment there in case there's something like we hadn't anticipated. But,
Yeah, I
but
think
again,
there's-
it's only,
yeah.
it's not to like invite, hey, what possibly might we be able to use this line for? Like, we're not looking to invent use cases, but it's for like truly exceptional situations. If you have a fact or circumstance that is gonna call for a different treatment or result in a different outcome, that just allows us from a programming and software perspective to like have a place that you can put it and get it right and provide a statement if you want to explain what you're doing. But so again, going down, we already went through the apportionment piece and the other factors that are just informational. But that is kind of pretty much the schedule right there of trying to get from that A to B of the federal items to what are we doing estimated payments on Vermont for. The adjustments, the sourcing, and moving on from there, and allowing the flexibility to report situations that don't land in our default world. And then we'll see on Thursday how these tie into the K1, because that's like kind of really where the rubber hits the road and the items can pass through to the individuals and corporations. And that's, again, this schedule's been more or less like this for 3 years, little improvements along the way, but the K1's big and brand new, and we'll look forward to talking about that on Thursday.